In the 21st century, humanity stands at a crucial intersection where prosperity and vulnerability exist side by side. Despite immense technological progress, rising global trade, and unprecedented access to information, the risk of an economic depression remains a constant shadow over modern societies. The idea that severe economic downturns belong only to the past, moments like the Great Depression of 1929, has been repeatedly challenged by recent events. The global financial crisis of 2008, the COVID-19 pandemic, supply chain breakdowns, and political instability have shown that the world economy is more interconnected, more fragile, and more capable of collapsing with astonishing speed. Understanding how an economic depression could unfold in the contemporary world requires examining not only economics, but psychology, geopolitics, technology, and the human decisions that shape markets every single day. Throughout history, economic depressions have been triggered by a combination of excessive debt, collapsing confidence, and structural weaknesses that build up silently over many years. Today, similar patterns are visible across multiple regions. Household debt in many developed nations is at historic highs. Corporations rely heavily on borrowed money. Governments across the world, from America to Europe to Asia, have accumulated record-breaking levels of national debt. These are not just numbers. They represent millions of lives shaped by rising costs, stagnant wages, and financial pressures that push people to the brink. When too many borrowers become unable to repay what they owe, when banks begin to fear widespread defaults, and when investors lose confidence in the future, a modern depression becomes not only possible, but dangerously likely. In the contemporary world, the seeds of an economic depression are often hidden beneath layers of optimism. People buy houses at high prices, believing values will always rise. Investors pour money into stocks, expecting endless growth. Governments borrow more to finance infrastructure, welfare programs, or political promises. While much of this activity helps economies grow, it also creates vulnerabilities. When a shock hits, whether from war, disaster, political conflict, or a global health crisis, the underlying weaknesses quickly surface. In a highly interconnected global economy, a disruption in one region can send shockwaves through the entire world. A factory shutdown in China can affect stores in Europe, companies in America, and workers in Africa. A shipping delay in one port can lead to shortages everywhere. Financial markets, once seen as reliable indicators of economic stability, have become increasingly volatile and speculative. Stock markets often soar on optimism rather than fundamentals. Real estate prices in many major cities have reached levels far beyond what ordinary people can afford. Cryptocurrencies, digital assets, and speculative investment vehicles attract billions of dollars, even though many lack intrinsic value or regulatory oversight. When confidence is high, such markets grow rapidly. But when fear enters the system, their collapse can be just as fast, wiping out wealth, triggering panic, and deepening economic hardship. One of the most significant differences between historic depressions and the possibility of a contemporary depression lies in the speed at which information travels. In the past, economic news spread slowly, bank runs, market collapses, and business failures took time to develop. Today, a single viral tweet, a leaked report, or political statement can cause billions of dollars to vanish within minutes. Social media amplifies fear, fuels speculation, and spreads misinformation at unprecedented speed. A rumor about a bank insolvency can trigger a digital bank run as millions of people transfer funds instantly. Unlike the past, where people physically lined up to withdraw money, today, withdrawals happen through smartphones. Faster, more widespread, and far more difficult to control. Geopolitical tensions add another layer of complexity. Conflicts between major powers, trade wars, sanctions, and diplomatic breakdowns can destabilize global markets. The rivalry between the United States and China, tensions involving Russia, disturbances in the Middle East, and political polarization in Europe contribute to a climate of uncertainty. Investors dislike uncertainty. Businesses avoid long-term commitments when political risks rise. Consumers reduce spending when their future feels insecure. All of these reactions contribute to the conditions necessary for economic downturns. Climate change, too, has emerged as a silent economic threat. Extreme weather events disrupt agriculture, threaten coastal cities, and damage infrastructure. Each disaster, whether drought, flood, hurricane, or wildfire, causes major economic losses. Insurance companies raise premiums or withdraw coverage entirely. Food prices rise due to lower crop yields. Governments spend billions on reconstruction. As these events become more frequent, they strain public finances and increase global instability. A world experiencing climate-induced crises is a world increasingly vulnerable to economic depression. Perhaps the most subtle but powerful factor contributing to the risk of a contemporary depression is the erosion of public trust. Around the world, people have lost confidence in institutions, governments, banks, corporations, and even the media. When individuals stop trusting financial systems, they change their behavior. They withdraw money from banks, reduce spending, avoid investments, hoard essential goods, or search for alternative currencies. These individual decisions, repeated across millions of people, can destabilize the entire economic system. A depression is not merely an economic event, it is a psychological one. Fear spreads faster than facts, and once confidence collapses, restoring it becomes extremely difficult. Another characteristic of the modern world is the central role of technology and automation in economic productivity. While technological progress has created millions of new opportunities, it has also replaced traditional jobs. Factory workers, cashiers, office assistants, drivers, and many other roles are being automated. Artificial intelligence is rapidly changing the job landscape. While new industries emerge, many workers struggle to transition or retrain. Job insecurity becomes widespread, savings decline, and financial anxiety grows. When large segments of the population feel economically unstable, consumer spending, the backbone of modern economies, weakens. Lower spending leads to lower business revenue, fewer jobs, and further economic contraction, creating a downward spiral that can lead to a depression-like scenario. Income inequality across the world has reached historic levels. A small percentage of people hold a vast portion of global wealth. Meanwhile, the majority face rising costs of living, growing debt, and stagnant wages. Economic depressions often occur when inequality becomes so extreme that the majority cannot participate fully in the economy. When ordinary people cannot afford housing, healthcare, or education, their reduced economic activity weakens the broader system. In contemporary society, inequality also fuels social unrest, political polarization, and distrust, factors that further undermine economic stability. Supply chain fragility is another modern vulnerability. The world relies heavily on complex networks of production and distribution. A single disruption, whether from a pandemic, political conflict, or natural disaster, can halt the movement of essential goods. The COVID-19 pandemic exposed the fragility of these systems. Factories shut down, shipping containers piled up at ports, medical supplies became scarce, inflation surged as demand outstripped supply. These disruptions showed how deeply interconnected modern economies are, and how disruption in one area can trigger cascading failures across the world. As inflation rises, central banks often respond by raising interest rates. While this helps control inflation, it also increases borrowing costs. Businesses struggle to finance expansion. Homeowners face higher mortgage payments. Governments must pay more to service national debt. When interest rates rise too quickly, they can trigger a recession. If the recession deepens and lasts long enough, it can evolve into a depression. Many economists argue that the balance between controlling inflation and maintaining economic growth has become increasingly delicate in today's EDRS world. Emerging economies face even greater risks. Countries in Africa, Latin America, and parts of Asia often depend on foreign investment, commodity prices, and global trade. When the global economy slows, these countries are hit the hardest. Currency devaluation, debt crises, food shortages, and political instability can quickly escalate. For millions of people living in vulnerable regions, even a mild global slowdown can feel like a depression. Despite these risks, many governments and institutions continue to assure people that the global economy is strong and resilient. And in many ways it is. Modern societies have tools and knowledge that previous generations never had. Central banks have mechanisms to inject liquidity. Governments can use stimulus packages. International organizations can coordinate responses. But these solutions are not infinite. Excessive reliance on borrowing, stimulus, and intervention can create bubbles that eventually burst. A depression becomes likely when attempts to fix economic problems simply postpone the inevitable correction. In contemporary society, the fear of economic depression is not just about losing money. It's about losing security, stability, and hope for the future. People worry about their children's prospects, about their savings, about the cost of healthcare, education, and housing. These anxieties shape behavior, and behavior shapes economies. When people feel uncertain, they take fewer risks, reduce spending, and hold back investment. Modern economies rely heavily on confidence, and when confidence cracks, the system weakens. Today's world contains all the ingredients that historically created large-scale depressions: high debt, rising inequality, geopolitical conflict, speculative bubbles, technological disruption, and widespread uncertainty. The only question is whether societies can recognize these warning signs in time, whether world leaders can act together, and whether individuals can adapt to the challenges ahead. The possibility of an economic depression in the contemporary world is real, not as a distant historical echo, but as a present and growing risk shaped by the choices we make today. As the global economy entered the 21st century, it carried with it the unresolved imbalances of previous decades, imbalances that would play a defining role in the depressions and downturns of the contemporary era. The surge of globalization created unprecedented connections between nations, allowing goods, capital, and labor to flow across borders with extraordinary speed. But this same interdependence also created shared vulnerabilities. An economic shock in one major country could ripple across continents, destabilizing financial markets, disrupting supply chains, and eroding investor confidence almost instantly. The world had become a tightly wired network, and in such a system, small failures could ignite large-scale crises. One of the most critical weaknesses that emerged during this period was excessive debt accumulation. Governments, corporations, and households began to rely heavily on borrowing as interest rates remained low and access to credit expanded. In many advanced economies, consumption increasingly outpaced production, creating structural deficits that widened year after year. While debt can fuel growth, it also magnifies risk. When confidence decreases and lending tightens, indebted systems begin to crack, creating the perfect conditions for depression-like downturns. The sluggish wage growth of the middle class, combined with rising living costs, only compounded this vulnerability, placing households on unstable financial ground. At the center of contemporary economic turmoil lies financial speculation, a driving force behind boom and bust cycles. Technological advancements enabled high-frequency trading, complex derivatives, and a global financial system operating at speeds humans could barely comprehend. These innovations, though remarkable, also distanced markets from real economic fundamentals. Prices of assets, from housing to stocks, began rising not because of production or value creation, but because of speculative momentum. When such bubbles burst, as seen in countless examples worldwide, they paved the way for deep and prolonged downturns. The 2008 global financial crisis represented a watershed moment. What began in the subprime mortgage market of the United States quickly morphed into a full-scale global disaster. Entire financial institutions collapsed, unemployment soared, and governments were forced to deploy unprecedented monetary and fiscal interventions. Though massive stimulus packages prevented a complete depression, the underlying wounds ran deep. Many households never fully recovered. Entire regions suffered long-term stagnation, and the crisis scarred public trust in financial institutions. More importantly, the 2008 crash exposed the fragility of a system heavily dependent on debt, speculation, and complex financial instruments that few truly understood. But despite the lessons of 2008, structural vulnerabilities persisted in many parts of the world. Economic inequality widened further, driven by unequal access to technology, financial assets, and global opportunities. The rich accumulated wealth at accelerating rates while workers confronted stagnant wages, weakened labor protections, and rising job insecurity. This imbalance weakened consumer demand, the lifeblood of any modern economy, and increased social tension. When millions struggle to afford basic necessities, while a small elite controls a disproportionate share of resources, the seeds of economic depression quietly take root. Complicating this landscape was the intensifying wave of automation. Robotics, artificial intelligence, and advanced software systems transformed entire industries. While these technologies boosted productivity, they also displaced millions of jobs, especially in manufacturing and routine-based sectors. Many workers struggled to transition to new roles, leading to regional inequality and persistent unemployment. A jobless recovery, an economic rebound without sufficient job creation, became increasingly common. This trend, if left unmanaged, can contribute to long-term depressions by reducing labor income and weakening overall economic demand. In addition to technological disruption, global trade tensions began reshaping the world economy. Nations that once championed free trade shifted toward protectionism. Tariffs, sanctions, trade barriers, and geopolitical rivalry created uncertainty across global markets. For export-dependent economies, even small changes in trade policy could trigger recessionary pressures. As supply chains fragmented, industries struggled to adapt, leading to reduced investment and productivity. When trade wars escalate, they do more than raise prices. They erode economic stability on a global scale. The contemporary world also faces unprecedented demographic pressures. Aging populations in Europe, North America, and parts of Asia strain pension systems, healthcare infrastructures, and labor markets. Fewer workers supporting larger retiree populations create fiscal burdens that slow economic growth. Countries with declining birth rates confront shrinking domestic markets and labor shortages. Without long-term structural reforms, such demographic trends could usher in a new era of stagnation or depression-like conditions, where economies can no longer grow at the pace needed to sustain their social systems. Environmental challenges further intensify economic vulnerability. Climate change introduces new risk factors: extreme weather, natural disasters, agricultural disruption, and rising energy costs. These events can wipe out infrastructure, reduce productivity, and force governments into massive debt-financed reconstruction. Climate-related economic shocks are often sudden and severe, pushing vulnerable regions into prolonged downturns. Food price spikes, water scarcity, and forced migration can destabilize local economies and contribute to global depressionary pressures. Another defining element of contemporary economic fragility is the concentration of power within multinational corporations and financial institutions. As a handful of companies dominate global markets, from technology to banking, they gain outsized influence over employment, pricing, innovation, and governance. When such institutions fail or face crisis, the consequences are felt worldwide. The collapse of a single major bank can trigger liquidity shortages, credit freezes, and widespread panic, conditions that mirror the early stages of economic depression. Market concentration reduces competition, limits opportunities for small businesses, and creates systemic risks that amplify financial instability. Political instability adds yet another layer to the complex web of contemporary economic risks. Populist movements, weakened democratic institutions, and rising authoritarianism create uncertainty for investors and disrupt economic planning. When political systems become volatile, policy decisions swing unpredictably, businesses hesitate to invest, households reduce spending, and financial markets react sharply. Such environments limit long-term economic growth and expose countries to depression-like declines. The role of consumer sentiment is also critical. In anxious societies, burdened by debt, inequality, and job insecurity, consumer confidence weakens. People spend less, save more, and adopt defensive financial behaviors. While this may benefit individuals in the short term, collectively, it reduces economic activity, lowers business revenues, and forces companies to cut costs through layoffs or reduced investment. What begins as a psychological shift can snowball into an economic contraction, demonstrating the powerful link between public sentiment and macroeconomic stability. Global interconnectedness means that countries today cannot isolate themselves from external shocks. A crisis in one region, whether a banking collapse, geopolitical conflict, or supply chain disruption, can send shockwaves through the global system. For many developing economies, dependency on foreign investment and commodity exports makes them particularly vulnerable. When international demand declines, currencies weaken, debt burdens rise, and growth stalls. Such economies can easily slip into depression-like states if global conditions fail to improve. In this intricate and fragile system, even minor disturbances can escalate into full-scale crises. Whether triggered by financial mismanagement, political decisions, technological disruptions, or natural disasters, the contemporary economy operates on a tightrope. Its strengths, speed, innovation, integration, are also its weaknesses. One misstep can cause wide-reaching damage, pushing populations into unemployment, poverty, and prolonged economic uncertainty. In the contemporary global landscape, one of the most unsettling characteristics of economic depressions is their ability to spread rapidly across borders, magnified by the interconnectedness of international trade, finance, and digital communication. In earlier centuries, a local depression might remain confined to a region. Today, a financial shock in a single country can ripple across continents within hours, affecting markets, currencies, employment, and consumer confidence worldwide. This interconnectedness was made clearly visible during the 2008 global financial crisis, when the collapse of a few mortgage-backed securities in the United States triggered a worldwide recession that cost millions of jobs and wiped out trillions in wealth. What made the crisis remarkable wasn't only its magnitude, but the speed with which it spread, demonstrating how deeply the world's financial systems are interwoven. In contemporary depressions, the role of psychological contagion has grown equally significant. Fear, uncertainty, and loss of confidence can act as accelerants, transforming small economic disturbances into major crises. Social media and instant communication amplify this dynamic, turning local anxieties into global panic almost instantly. A false rumor about a bank's stability can spark real bank runs. Concerns about a corporation's solvency can crash its stock price within minutes. These psychological waves, while intangible, have real consequences, forcing policymakers and central banks to manage not just the economy, but also the collective emotional state of markets and citizens. This makes modern depressions unique. They arise not only from economic fundamentals, but also from the speed at which information, speculation, and emotion spread across a hyper-connected world. Another defining feature of economic depressions in the contemporary era is the burden of global debt. Today, sovereign debt, corporate debt, and household debt levels are higher than at any point in recorded economic history. While debt can fuel growth, it becomes a suffocating weight when economic conditions deteriorate. Countries with high public debt face limited policy options during crises, as printing money may ignite inflation, and austerity measures may deepen recession. Corporations, especially in emerging markets, often rely heavily on foreign currency loans. When local currencies weaken, their debt burdens become unmanageable. Households, burdened with mortgages, student loans, credit card debt, and personal loans, struggle to maintain consumption when income falls. These debt dynamics create a fragile economic foundation, where small shocks can escalate into severe depressions, because so many households and institutions are already stretched thin. The digital economy, while providing opportunities for innovation and efficiency, introduces new vulnerabilities during economic downturns. Industries built on venture capital, speculative investment, or advertising revenue can collapse rapidly when markets tighten. Companies with massive valuations but fragile cash flows, particularly in tech, fintech, and media, often face severe contractions or bankruptcies during depressions. Remote work, digital transactions, and platform-based economies also create unique stress points, as layoffs in one region can cascade across global teams, supply chains, and customer bases. While the digital economy has made certain sectors more resilient, it has also concentrated power among a few large corporations, leaving smaller businesses vulnerable and widening inequality during depressions. Global supply chains represent another major vulnerability in the contemporary world. Over the past few decades, corporations optimized production for maximum efficiency, relying on just-in-time inventory systems and sourcing components from multiple countries. While this lowered costs, it reduced resilience. When a depression hits, especially when triggered by geopolitical conflict, natural disaster, or pandemic, supply chains can freeze, leading to shortages of essential goods, rising prices, and slower economic recovery. The disruptions of recent years have highlighted how fragile these systems are, prompting countries and corporations to reconsider the balance between efficiency and reliability. As supply chains become more localized or diversified, economic depressions may become less severe, but the transition period itself introduces new risks and instability. A critical aspect of contemporary depressions is the widening gap between the rich and the poor. Inequality intensifies the impact of downturns because the majority of the population has limited financial buffers. When wages stagnate, savings remain low, and essential expenses rise, even a short economic shock can devastate households. During depressions, low-income individuals often lose jobs first, face the greatest challenges in securing new employment, and struggle with rising prices for housing, healthcare, and essential goods. Meanwhile, wealthier individuals may experience temporary losses, but generally recover faster because they hold diversified assets and maintain access to capital. This divergence deepens social tension, fuels political polarization, and increases the risk of unrest, making depressions not only economic challenges but also social and political crises. In the contemporary world, technological automation introduces a paradoxical threat during depressions. While automation increases efficiency during stable periods, it displaces workers during downturns, making recoveries more uneven and fragile. When companies integrate robotics, artificial intelligence, and algorithmic management, they reduce labor costs but increase structural unemployment. As more jobs become vulnerable to automation, from manufacturing and logistics to clerical and customer service, the ability of societies to absorb displaced workers diminishes. During depressions, this translates into prolonged unemployment for large segments of the population, slowing consumption and delaying recovery. Policymakers face difficult questions: how to protect workers, encourage innovation, and maintain economic stability without compromising long-term growth. One of the most alarming characteristics of modern depressions is the rise of geopolitical tension. Economic weakness often fuels nationalism, trade disputes, and territorial conflicts. Governments facing domestic pressure may resort to protectionism, tariffs, or political aggression as a means of diverting public attention. These actions, however, tend to worsen global economic conditions, reducing trade flows, destabilizing currencies, and discouraging investment. The risk of geopolitical conflict, whether through trade wars or military escalation, becomes intertwined with economic performance, creating feedback loops that make depressions deeper and more prolonged. Despite all these challenges, contemporary societies possess tools that previous generations lacked. Central banks can deploy advanced monetary policy instruments. Governments can implement rapid fiscal responses. International organizations can coordinate rescue packages and financial stabilization measures. Data analytics, satellite monitoring, AI-based forecasting, and real-time financial tracking give policymakers unprecedented insight into emerging risks. These tools do not eliminate depressions, but they provide mechanisms for intervention, softening the impact and accelerating recovery. The challenge lies in ensuring these tools are used effectively, transparently, and equitably, so that recoveries benefit all segments of society rather than a privileged few. Ultimately, contemporary economic depressions reveal the delicate balance of the modern world. Nations are connected, yet divided, technologically advanced, yet fragile, prosperous, yet unequal. Each period of economic decline exposes fundamental weaknesses in the global system, urging societies to rethink how economies function, how wealth is distributed, and how resilience can be built in a world where uncertainty is the only constant. As the global economy continues to evolve, the lessons learned from recent depressions will shape the policies, innovations, and social structures that determine whether future crises are manageable setbacks or catastrophic declines. In the contemporary world, Preventing and mitigating economic depressions requires a complex interplay of policy decisions, international cooperation, financial innovation, and public resilience. Governments today are far more conscious of the risks and chain reactions that can turn a recession into a depression. Yet, despite this awareness, the global economy remains deeply vulnerable. The very forces that have accelerated growth, globalization, technological interconnection, cross-border capital flows, also create new channels for crises to spread faster than ever before. Understanding how nations attempt to stabilize their economies in this era reveals the fragility and adaptability of modern financial systems. One of the most critical tools for managing downturns is monetary policy. Central banks worldwide have adopted aggressive strategies to prevent deep depressions, especially after learning painful lessons from past crises. Interest rates are lowered swiftly to encourage borrowing, stimulate investment, and support consumer spending. But modern challenges present a new complication. Many countries already operate with extremely low or even negative interest rates. This limits the power of traditional monetary tools. When a crisis begins and rates are already near zero, central banks struggle to find effective levers to pull. This reality forces nations to rely more heavily on unconventional tools like quantitative easing, bond purchases, and targeted lending programs. While these measures can provide temporary relief, they also carry risks, such as inflating asset bubbles or increasing long-term debt burdens. Fiscal policy, meanwhile, becomes essential in cushioning downturns. Governments increase spending on public works, social support programs, healthcare, and unemployment benefits to maintain consumer demand. This intervention can be the difference between a short-term recession and a prolonged depression. Yet not all countries have equal capacity for fiscal stimulus. Developing nations often face high borrowing costs, fragile credit ratings, and limited access to international financing. For them, preventing an economic depression becomes far more difficult. The inequality in stimulus capacity means that global downturns can create widening gaps between rich and poor nations, intensifying social tension, migration pressure, and political instability. The role of international institutions becomes especially crucial during global crises. Organizations like the International Monetary Fund, World Bank, and regional development banks provide emergency funding, debt restructuring assistance, and economic guidance. But these institutions have their limitations, and their policies often spark controversy. Critics argue that structural adjustment programs, requiring austerity, privatization, and financial liberalization, sometimes worsen downturns rather than alleviating them. Supporters, however, claim that disciplined reforms create long-term stability and reduce corruption. In the modern world, navigating these conflicting views is part of the challenge of avoiding economic depression. A unique feature of contemporary depressions is the heightened influence of technology, both as a stabilizer and destabilizer. On the positive side, digital finance, online banking, and fintech innovations provide new ways for people to access credit, transfer money, and participate in the economy. Remote work capability prevents productivity from collapsing during crises like pandemics. Data analytics allow governments and financial institutions to detect trends earlier and respond more quickly. Yet, technology also accelerates panic. Social media can magnify market fear in seconds, triggering bank runs, stock sell-offs, and currency volatility. Automated trading systems react instantly to negative indicators, causing massive, rapid swings in global markets. Cyber attacks pose another threat. An attack on a major bank, energy grid, or payment network could trigger a financial crisis far more rapidly than traditional economic weaknesses. Thus, the modern economy is both empowered and endangered by digital interconnectedness. Another factor that shapes the modern risk landscape is geopolitical fragmentation. The emergence of multipolar power structures, trade wars, sanctions, and proxy conflicts disrupt global supply chains and energy markets. Nations increasingly prioritize self-reliance, reducing international coordination and complicating crisis response. When powerful countries fail to cooperate, smaller economies often suffer the consequences. A conflict between two major nations can send shockwaves through commodity markets, currency systems, and global trade networks, increasing the likelihood of a wider depression. Environmental risk further complicates economic stability. Climate-related disasters, storms, droughts, floods, wildfires, damage infrastructure, reduce agricultural output, and strain government budgets. Insurance companies struggle to keep up with rising claims, and investors reassess the viability of long-term projects in vulnerable regions. These pressures accumulate slowly but steadily, pushing fragile economies closer to collapse. Food shortages, water scarcity, and mass displacement create social pressure that can explode into economic breakdown if not properly managed. Despite these threats, societies also demonstrate remarkable resilience. In many countries, communities have developed stronger social networks, digital economies, and adaptive industries that soften the impact of downturns. Entrepreneurs innovate rapidly during crises, finding opportunities in e-commerce, renewable energy, telemedicine, and automation. Governments invest in education, skill development, and research, building the foundation for long-term growth. Even after severe economic turmoil, nations often emerge with stronger institutions, smarter regulations, and more diversified economies. However, the greatest determinant of whether an economic downturn becomes a depression remains public confidence. Financial systems depend on trust that banks will honor deposits, that governments will manage debt responsibly, and that institutions will protect the public interest. When confidence deteriorates, even healthy economies can fall into crisis. This is why effective communication, transparency, and strong leadership are more important than ever in modern economic management. When people believe their economy is stable, they spend, invest, and innovate. When fear spreads, even the strongest economies can crumble. The future of preventing depressions will depend on integrating economic policy with technological innovation, climate resilience, and global cooperation. Nations that can adapt to evolving risks, strengthen social protections, and invest in sustainable growth will be better prepared to face tomorrow's economic challenges. Those that remain dependent on old systems, over-leveraged industries, and fragile political structures will be more likely to face deep and prolonged downturns. In the end, the story of economic depression in the contemporary world is a story of vulnerability and adaptability. The global economy sits at a delicate intersection of technology, politics, environment, and human behavior. Crises will continue to emerge, but with knowledge, preparation, and cooperation, societies can transform uncertainty into resilience. The modern age brings unprecedented risks, but it also provides unprecedented tools to navigate them. The challenge lies in using those tools wisely, recognizing early warning signs, and acting decisively before instability becomes disaster.